Okay, we are live with the review for Exam 2. I realize that we have not had lecture on business entities, but I'm not going to do a separate full lecture on that. It is a relatively short chapter. I am going to highlight the things that I want you to know. I won't eliminate a whole lot there. I want you to understand the framework for which, by the way, I'm going to ask questions and I'm going to point these things out to you. It's a relatively short, it'll be a relatively short overview, easy to understand, and we'll just go with it from there. So, going to start off with the first chapter we covered since chapter 2. Just going to let you know the things that I think are most important that you're likely to be tested on in terms of risk management. So I'm going to flip fairly quickly as we go through the slides. Slide 6. I want you to understand, as we pointed out, insurance is not to cover life per se. It is not to cover health per se. Insurance can only cover two things: income and assets. And obviously, our ability to earn income is an asset. But if you just think of it in terms of those two things, income and assets, I think you'll have a good understanding of what insurance is about. Life insurance is one of the things that primarily covers income for people who buy it for estate planning reasons, so that they can preserve the values of their estates for the for future generations. They're covering it for assets. Most people in their working years who buy life insurance are buying it for income replacement reasons. The other type of insurance that people buy for income replacement reasons is disability insurance. So these are the two: life and disability. The life, as we said, also for untimely death late in life, is to cover assets. Healthcare is to cover our assets. It's not going to make us any more well just by the fact that we buy health insurance. It's not going to buying health insurance is not going to restore us to good health. We buy health care in order generally for catastrophic reasons, in case we have very large expenditures, so we don't end up owing lots of money that we can't pay. Property and casualty insurance is obviously, that's for home and auto. Typically, those things are covering our assets. Liability insurance is a protection on our assets if we get personally sued. There are multiple types of liability insurance. The primary one that I want you to understand for this test is an umbrella policy, or personal liability umbrella policy, often known as a PLUP. The key term there is umbrella. So it covers if you are to get sued for some reason that has to do with not maintaining your home or driving your car. Someone sues you. Also, it can be for something that may happen at the grocery store, things like that. It won't cover you for professional liability. Doctors have professional liability insurance known as malpractice insurance. Financial planners have professional liability insurance known as errors and omissions insurance. So those are different types of liability insurance that are for the professional side, but they are also trying to protect assets. Slide 7, triple star. This slide, I want you to understand that what the risk management tactic that we want to take as it relates to frequency and severity. So you see frequency on the top of this matrix and severity on the left side of insurance. So the methods that we can choose to manage risk are to transfer that risk That is, insurance is a type of transfer. I transfer the risk that I have to an insurance company, and we pay a price for doing that, known as the premium. I can avoid a risk. Avoiding a risk means, and because I don't want to go splat from jumping out of an aircraft, I can avoid getting killed jumping out of an aircraft by not jumping out of the aircraft. Also, same thing, risk might be particularly high on a motorcycle. I may choose to avoid, that risk because the severity of getting of the loss when you get in a wreck on a motorcycle is relatively high. I may choose to avoid that risk. We can retain risk. Risk is retained, and we'll talk about an example here in a minute. An example of retaining risk is when you have a high deductible, or you have a deductible. You're retaining a portion of that risk. And then we can do things to reduce the risk. And we can reduce risk by trying to lower the frequency of a loss, or we can reduce risk by trying to lower the severity of a loss. A grocery store might try to reduce the risk of reduce the frequency of shoplifting by posting signs saying that we prosecute shoplifters, and conspicuously placing cameras around so that shoplifters can see them and won't try to shoplift, and also having those things at the door that chime, make an alarm when somebody goes up. Those are things that stores may do to try to reduce the risk. Okay, so in terms of a high frequency and high severity loss, in other words, it's going to happen all the time, and when it does, it's going to be catastrophic financial loss for me. If in a case like that, I would like to be able to transfer the risk, but the premiums are going to be so high that I'm not going to be able to afford. So my only option that is feasible is to avoid that risk. High frequency, high severity losses. If I like jumping off of relatively high places without a parachute, I have a high frequency of injury. And say I like to jump off a 12-foot roof, something like that. Lots of people do thrill-seeking type things that are high frequency and high severity of loss. My only choice is really to avoid that risk, because it'll cost too much money to try to transfer that risk. The high severity and low frequency, high severity, catastrophic financial loss. Low frequency, it hardly ever happens, so I am going to be able to afford to transfer that risk, such as the case of premature death for someone in their 20s or 30s. Happens fairly infrequently, but it would be catastrophic to my family if I were to get killed on the way home from work today. So I do want to transfer that risk because of the severity. And because it hardly ever happens, I will be able to transfer it because the premiums will be affordable. Staying in the low frequency column, low frequency, low severity. If it almost never happens, and when it does happen, it's not going to be catastrophic, I can retain that risk because it's basically almost costless to me to retain that risk, and it's not worth my hassle to even try to deal with that. For example, I live on a road that there's not a sidewalk, and so I have some plants in my front yard. The people might walk on walk on those plants occasionally, or a dog might come and urinate on the plants, but it's not going to happen with, it doesn't happen with enough frequency that it becomes a big bother to me. What I do, I just go out and replace a plant if that happens once a year. Pretty low frequency and pretty low severity. It costs a few dollars at the grocery store to buy another annual plant. Not a big deal. High frequency, low severity. This is like shoplifting at the grocery store. Happens all the time. When you think about all the things, the tens of thousands of items that a grocery store carries. But a few grocery items walking out the door is relatively low severity, but because it happens so often, it can add up. So they do the things to try to reduce that risk. Like I said, given the example of that. So they try to reduce the that's an example of reducing the frequency of the risk. Reducing the severity of the risk, I might be putting on a seatbelt. It doesn't make me any less likely to get into a car accident, but it may make the severity of bodily injury lower in the case of a car accident, just because I have a seatbelt or because I have an airbag. So that is an example of risk reduction. That is aimed at reducing the severity of the loss. Okay, those are the main things that I want you to understand as it relates to life insurance. Slides 6 and 7 are the most important slides in this chapter. I'm going to just kind of start clicking through here pretty quickly. Would like you to understand the difference between a peril and a hazard. A peril is the proximate cause or actual cause of loss. A hazard is the condition that creates that hazard. So an icy road is a hazard. The peril is the vehicle crash that is caused by or that has made the condition that made the peril more likely to happen. The loss is whatever the damage is to my car. Hazard, peril, loss. Understand that. Okay. Life insurance needs calculation. Understand that we can use the human life value approach. This is what an economist would use. Typically called up in a lawsuit for wrongful death or something like that. What did this person spend? Or what did they earn minus what they spent? This is the human life value method. Then there's the financial needs method. The financial needs method takes into account what I would have earned, but also takes into account what my resources are. So this is more like what financial planners do. We say this is how much your total need is, and then here are the resources that you have in place. Somebody with a lot of money saved up needs less insurance because they can afford to self-insure. Someone who's relatively close to retirement should have, according to the financial needs method, their need for life insurance goes down as they get closer to retirement age. And then the capitalization of earnings method. This just means that this is basically a time value of money approach. You can see the example here. It's basically living off the interest. So here's the example. If you needed $65,000 of income, you use the risk-free rate, which is the treasury bond rate, divide just by the interest rate, and that's what you could afford to live on. You can also use the inflation-adjusted method, which gets to the inflation-adjusted rate of return. subtracting out the personal consumption. So basically, there it is. All right, managed care options. Want you to understand HMO, PPO, and point of service. HMOs are going to be the least costly and offer the least choice. Point of service is going to be the most costly and offer the most choice. PPO is in the middle on both. Would like you to understand that. Disability, I think we covered that. Long-term care insurance is a payment plan for elderly people, generally for elderly people, in case they are in need of long-term care. Auto insurance wants you to understand the basic thing that almost every state requires liability insurance. Collision or comprehensive insurance is not required by law. And then we get to the personal liability. Okay, insurance, and then going into education. Okay, understand the factors that a planner needs to consider when making a recommendation to clients. What factors need to be considered? We went through this. This is why we went through it in class when we built the sinking fund piece of analysis. I want you to understand how those pieces work and how they work together. I want you to understand here on slide 6 that tuition inflation has outpaced general inflation quite significantly, particularly over the last 30 years. And relatively speaking, you can see that in about 1980, general inflation and tuition inflation were roughly the same. And because basically for the last 30 years, general inflation has lagged tuition inflation. The real cost of sending a kid to college as compared to a generation ago is about 2.5 times as expensive. I want you to understand you have to file the FAFSA in order to get financial aid. The FAFSA takes into consideration the expected family contribution. Grants, you don't have to pay back. Loans, you do. Subsidized loans do not have, the interest is not compounded while you are in school. Unsubsidized loans, they begin capitalizing, or the interest begins compounding from the date that you take the loans. Qualified tuition plans or savings plans, these are 529 plans. I might ask you some questions as to what factors you should consider when choosing a 529 plan for one of your clients. I won't ask you to memorize Coverdell or Series E. You got interest deduction. Student loan interest is deductible, $2,500 a year. Not going to ask you anything about that. Okay, tax credits. The American Opportunity Tax Credit and the Lifetime Learning Credit. There's a slide. Okay, no double dipping on benefits. You can't use one credit for the other, and also you have the ability to deduct certain education expenses and pay for certain education expenses with a qualified tuition plan, aka a 529, but you're not allowed to take a deduction and then use the qualified tuition plan to pay for that and use the credit on it. You're not allowed to double or triple dip like that. Here are the two credits. I'm not going to ask you specifically about the phase outs on either one of these credits. Understand that a credit is a dollar for dollar offset on your taxes. So all things being equal, I'd rather have a credit than a credit rather than a deduction. I do want you to know that. And I'm not going to ask you about UTMA and UGMA accounts. I do want you to know that some employers may provide tuition assistance, which can be tax-free. And then education funding, I'm not going to ask you to go into the different alternatives. I may ask you a time value of money question. If Bill and Joe have a kid and the kid's a certain age and they're going to college at age 18 and they have a certain amount saved, how much do they need to save in order to have college fully funded by the age of 18? That's all I want you to know about the education section. Okay, moving on to investments. Chapter 9, just want to highlight again the things that I want you to cover. I want you to understand objective risk tolerance, which is ability, and subjective risk tolerance, which is willingness. I do want you to understand the relationship between risk and return relative to the asset classes. I want you to understand that risk and return generally move in the same direction. So we looked at stocks, government bonds, and government bills. Government bills are basically bonds that are just shorter in term. As we see, the expected return goes down as we go from stocks to bonds to bills, as does the risk as measured by standard deviation. Stocks, bonds, bills. I want you to understand that. I want you also to understand, for now, I'll just leave it at that. All right. I do want you to understand the weighted average return versus the weighted average versus portfolio standard deviation. If you calculated the weighted average return, the expected return of a portfolio is the weighted average return of the underlying securities. The risk of the portfolio, as measured by the standard deviation of the portfolio, is less than the weighted average risk of the portfolio, as measured by of the underlying securities, as measured by taking the average of the standard deviations of the underlying securities. And that is because of correlation. I want you to understand that. Anytime correlation is less than 1, then what I just said is true. I want you to understand systematic and unsystematic risk in general, what they are. I want you to understand that as the more you diversify, the more you get away, that you reduce unsystematic risk. Just by the fact of investing, you have systematic risk, and there's nothing that you can do about that. Understand beta is volatility relative to the market, and it is a measure of systematic risk only. Standard deviation is a measure of volatility relative to the expected return. So it is therefore a measure of total risk. Standard deviation is total risk. Beta is systematic risk only. I want you to understand how standard deviation works. That specifically the way that I drew it in class, if we had a mean number here, 2/3 of the time, actually 68% of the time, it would be plus or minus 1 standard deviation. Actually, we could say that within 1 standard deviation to the left of the mean would be 34%, and 1 standard deviation to the right of the mean would be 34%. and so forth and so on, such that we know that this little tail out here is only 2.5%, and this is only 2.5%. Understand how we can tell certain things about the distribution of the normal curve or the bell curve based upon just understanding the return and the stated standard deviation. Modern portfolio theory, the efficient frontier. I'll get into this. I remember showing you the thing that I wanted you to know in class. I had a different set of slides, which I'll bring that back up. I want you to understand that portfolios A and B on the efficient frontier are efficient. C and E are inefficient, meaning that you can get higher return for a given level of risk or the same level of return by taking less risk. For example, portfolio C and portfolio A take the same amount of risk. Get the same amount of return, but portfolio A takes a lot less risk. So portfolio A is preferable. Portfolio D, above and to the left of the efficient frontier, is not achievable. The capital asset pricing model, also known as CAPM, uses beta, and the expected return of the security or the portfolio is the risk-free rate plus beta times the market the market premium, the market risk premium. So look at these slides. I will ask you to do an example using CAPM. I don't think I went over PE ratio in class. I would like to reserve the right to ask you a question on the PE ratio. It's just the price of the stock to the it is just the price of the stock divided by the earnings per share, or the price of the or the value of the overall company divided by the earnings of the overall company. Either way you look at it. And so I want you to understand that the cheaper stock is not the one that has the lower stock price, but rather the one that has the lower PE ratio. Debt. The main things I want you to understand about debt. There are two things. What are the two worst things that can happen if you loan someone money? Well, number one is that they don't pay you back. That is credit risk. And number two is that the purchase the interest rates could go up, or my purchasing power could go down if I loan money out for a long time. At a locked in low interest rate, then interest rates could go up and inflation could go up and I could lose purchasing power. So that's the second worst thing that can happen. So duration measures the average amount of time that it takes me to get my dollars back. So that takes into consideration how long that is. Credit risk is measured by credit rating. Zero coupon bonds don't pay a coupon, don't pay any interest during the course of the loan. Rather, they wait until the end to pay you all of your money back, which is principal plus interest. As such, the maturity and the duration equal each other, because on average if I don't get any interest back for a 30-year loan and they all pay me at the end, on average I get my dollars back 30 years from now. the duration of a 30-year non-zero coupon bond, I'll get my interest payments every 6 months. So I'll get some money 6 months from now, some money 12 months from now, some money 18 months, so forth and so on. Every 6 months I'll get some money, and then at the very end I'll get my last interest payment plus all of my principal back. So on average, I will get back, on a 30-year bond, I'll get my money back, let's say, in 18 years. That may be a duration. That means just the average length of time it takes me to get my dollar back. Mutual funds are pooled investments that offer instant diversification and professional money management on a cheaper way than someone could do on their own. The Sharpe ratio, I would like for you to understand how this works. The Sharpe ratio is basically based upon it's kind of like the CAPM, except it uses standard deviation. I want you to understand, but it is the risk premium, the standard deviation of the portfolio minus the standard, it is the return of the portfolio minus the risk-free rate, so that is the risk premium, over the standard deviation of the portfolio. So I would like you to understand the Sharpe ratio, how to calculate it, and a higher Sharpe ratio is better. Trainer is basically like the Sharpe ratio. Alpha, except it uses beta like the CAPM does. And then alpha is basically takes the capital asset pricing model, and it says but it checks to see if the return of the portfolio is higher than would be predicted by CAPM. If it is higher than would be predicted by CAPM, then we have a positive alpha. I'm not going to ask you regular test questions on these, but I will potentially ask you bonus questions on these. Okay, let me pull up my investments slide. Okay. Basically the same thing as the other portfolio showed. What makes a portfolio efficient? One of the things is the correlation. That is basically the magic factor. When one asset zigs, the other asset zags, and therefore I may be able to reduce the risk of my portfolio without giving up any expected return. This is because I can reduce my risk, and the risk that I can reduce is not my systematic risk, but my unsystematic risk. Inefficient portfolios have unsystematic risk, which is synonymous with uncompensated risk. We are only compensated for systematic risk. Determinants of return. I want you to understand this, that security selection and market timing aren't unimportant. But how do we decide, how do we figure out why one portfolio that's professionally managed even outperform different than other portfolios that are professionally managed? Only 8.5% of the difference is due to security selection and market timing or any other types of factors like that. 92% of it is due to asset allocation, basically meaning the percentage of stocks, cash, and bonds. So if it was a really good year in the market, mutual funds that were 100% stocks are generally going to outperform those that were 100% bonds or even 50% stocks. So Understanding volatility of expected returns, it is critically important that you understand that the longer the evaluation period we take, the average expected return, the average annual expected return remains the same. But the longer the period we take, we look at to evaluate uh, our volatility, the more certain we are to be closer to the expected. This is an example of the law of large numbers. So this is also the reason when we talk about risk tolerance. Here over 5-year periods, the vast majority of the time, stock returns are positive. And over 20-year periods of time, almost all the time, stock returns are positive. And the average annual return doesn't matter the period in which we measure. Okay. Expenses are important. I want you to understand that. It only matters what the clients get to keep. High expenses can be a drag. The former Goldman Sachs chief investment officer, a guy by the name of Mark Carhart, did a dissertation and studied over 1,800 surviving actively traded mutual funds back to the 60s. He did this in the 90s, so it was only over a 30-year period, and then found that active funds trailed the market by about 1.8%. A lot of people in the industry buy mutual funds based upon past performance. This slide, as we showed in class, shows that is a very bad idea. It means that you are more likely to lose to the market than just selecting at random. We showed this in class, and this guy Bill Miller beaten the S&P 500 for 14 or 15 straight years. And then what ends up happening is people say, "Oh, geez, this guy has the magic touch," and perhaps he did have the magic touch. But if he did, he lost it because in 2008, 9, and 10, he gave back all of his outperformance and then some, and so his clients really lost. Okay, investor behavior. We know that you profit by buying low and selling high in anything. But human nature leads us to do just the opposite of that. We get more conservative when we sense risk, and we sense risk after the market's gone down and the news is really bad. So when things are low, we're more likely to sell, and we become more opportunistic, thus taking on more risk, buying more when the market has been really good for a long time. Prices are up. We buy when prices are high. So what does this mean? It means that the average mutual fund investor does a lot worse than if they were just buy and hold investors. Over the period of 91 to 2010, had some very bad years in there, much lower than the historical average 20-year return. But if you just bought and hold the average equity mutual fund, which by the way trailed the S&P 500 by a little over 1.3%, but if you bought the average equity mutual fund and just held it for 20 years, you got a 7% return. But very few people did that just by taking money in and out and letting human nature take over. You average 3% a year. Well, what does that mean on a compounded basis? It means 51% less money after that 20-year period. And if you have half as much money over 20 years, that means that turns into a quarter as much money if you repeat that the next 20-year period. And people consistently do that. So, points out the value of advice. People are living longer. Clients have even longer term goals than they did in the past. But the focus has become much shorter term due to basically Wall Street coming to Main Street. And we've got, the 24-hour news cycle. We had, CNN, CNBC, Bloomberg, the internet. We got the smartphones, and you can see that the average holding period for an individual stock is now much less than a year, which back in the 60s it was over 8 years. So, understanding risk tolerance is key. Clients need to be able to stomach the ups and downs of the market, but realistically, they should be invested more aggressively the longer term the longer their time horizon is. Don't get greedy in good times. Again, this kind of goes with number one. Stomach it in bad times. Don't get greedy in good times. Be consistent. So, I want you to understand those are the important things that I wanted you to know about investments. And I'm going to get into retirement here. Okay, moving on to retirement. The importance of saving early. The earlier you start, the less you have to save due to the power of compounding. People at this is just an example of estimates of how much people should have. Don't need you to really memorize this. I do want you to kind of take a look at it, though, to understand that the older you get, the higher the ratio of the amount that you have saved to what your lifestyle should be, or to where your income should be. Okay. Here's the example. Lori started at 25, saving at 25, saving $2,500 a year for 10 years. Peter waited. Peter waited until age 35, and then I guess saved again at age 65. They earn 8% a year, and Lori has more than Peter. Well, the reason why Lori has more than Peter, even though Peter saved more than 3 times as much as Lori, I showed you this in Excel, and as we pointed out, is that the interest, by the time Lori quit saving, the interest alone is more than Peter starts saving. So this is critically important. The most valuable dollar that you ever save will be the first dollar that you save. So it is important to just get started. But I want you to be able to understand why. This is a vignette, but being able to explain the why is critically important. I want you to understand, again, the relationship between returns and standard deviation. I want you to understand the 4% approach. This is a guy named Bill Bingen. I talked about him in the lecture that I did in class. That basically said if you've got $1 million, you can take out $40,000 your first year in retirement, and then you can save and then take out $40,000 adjusted for inflation each year thereafter. As he assumed that if you live 30 years and you looked historically and said, okay, you wouldn't have run out of money something like 95% of the time. Wage replacement ratio. Basically, what does this mean? It just means that how much money do we need to live on after retirement versus what we earned before retirement. There's nothing really magic about this. So we don't need, when we're in retirement, we don't need to buy disability insurance. We don't need to pay payroll taxes. We don't need to save any more money for retirement once we're already retired. So the wage replacement ratio is typically lower than 100%, because we spend a little bit less. Although people may spend more on certain aspects in retirement. So that's not true 100% of the time. Some people, their discretionary expenditures through playing golf and fishing and leisure discretionary expenditures may go up significantly, particularly in the early years of retirement. Okay, sources of retirement income. This is basically, I don't think I went to my lecture, but in class, this is the three-legged stool: Social Security, pensions, and personal assets and savings. And I'd like to put personal assets and savings, 401ks, I'd like to put that in there because those are kind of buckets of money that you save. Pensions and Social Security, those are checks that people get for a lifetime. Social Security is getting weaker. It's projected to be out of money by the end of about the year 2030. It used to be 2039 when I first started talking about this 5 years ago, but the projections keep getting worse. What does that mean? They're going to be able to pay out only 76 cents on the dollar because they'll still be collecting, but there won't be any money saved up, assuming that they keep kicking the can down the road. And then fewer and fewer people are getting pensions. So personal assets and savings need to be higher. Okay. You understand capital needs assessment. Basically, this is just applied time value of money for retirement planning. So, sensitivity analysis. I want you to understand what are some things that you can do. One of the problems with the sinking fund approach, or the time value of money approach, is that it doesn't answer the question of what if I'm off by a little bit. Sensitivity analysis looks at, I can change each factor. I can say, okay, well, what if inflation's 4% instead of 3%? How will that affect my retirement sustainability? What if I live for 35 years instead of 25 years in retirement? How will that affect my retirement sustainability? Things like that. What if I'm, have some health thing that allows me to only work till 60 instead of 65? How will that affect my retirement sustainability? So I can look at, what if I change each one of these factors and move it a little bit? How is that going to affect things? That's sensitivity analysis. Monte Carlo analysis, as we talked about in class, Monte Carlo analysis just says, hey, I'm going to plan 1,000 different lives and 1,000 different sequences of returns. With Monte Carlo analysis, combined with the Bill Bingen approach, and I'll talk about that when I pull up my slide show here in a second. On retirement optimization. So the Bingen approach, basically, two of the problems I have with the Bingen approach is that it plans for people to live an artificially long period of time, and it treats let's say like 30 years. Lots of people are going to live 30 years in retirement. It's just that most aren't. So what that means is, if we necessarily plan for that, there's going to be a lot of money left on the table. People won't enjoy their lives as much as they would if they make really conservative assumptions, like really long life expectancy, really low rates of returns, thing like that. That's the problem with the Bingen approach. And the failure focus is too rigid. Running out of money at age 94 and a half, assuming that I live to 95, is considered a failure, and that is not treated as differently as running out of money at age 77, which is, starting from the age of 65, you're a lot more likely to be alive at 77 than you are at 94 and a half. So, the Bingen approach and traditional retirement modeling don't take that into account. These other things that I went and talked about in class, I'm not going to test you too much on that. I want you to understand that a reverse mortgage allows people to live on the equity that's in their home without them being forced to move out. That annuities, a SPIA stands for single premium immediate annuity. A SPIA that basically lets me pensionize part of my assets. We said pensions were going away, so we have a bigger bucket of money. I can take a portion of that bucket of money and buy an annuity with it. So that is what, and the most pure type of annuity is an immediate annuity. Longevity insurance is like an immediate annuity, gives me a paycheck until I die. But because I'm unlikely to run out of money, say between 65 and 75, it allows me to defer getting that paycheck. So the paycheck grows over that period of time. I retain the portion of risk when I'm least likely to run out of money. So one of the things that I want you to understand, when we talked in the investment section, that risk tolerance matters. Your ability, and not just investment risk tolerance, is about stomaching the ability and willingness to stomach to have volatility in an investment portfolio. Retirement risk tolerance is the ability and willingness to reduce consumption should it become necessary in exchange for a higher average expected amount of consumption in retirement. So how much can people take? People with pensions, with large pensions, can afford to be more aggressive, take out a higher percentage than 4% than Bingen would have said. If they do run out of money, because let's say 80% of their expenses are covered by a paycheck that's till death, versus somebody who doesn't have one and only has 20% of their expenses covered by a paycheck till death through the form of Social Security. So clearly these things matter. The ability to take a risk and the willingness to take to reduce is different too. So understand generally the relationship here. When I did multiple questions where I said, okay, there's a 90% of the time you can expect to receive 110,000, and then question 2 went basically basically you've got a good state and a bad state. So going from question 1 to question 2. Question 1, the bad state is really bad, only 10,000 a year, but it only happens 10% of the time. What I can do is make it more likely that I'll run out of money, but less likely, less bad when I do run out of money, which is kind of a strange trade-off to make. But what it does is it means that I'm willing to take on more risk. The 110 became $112,000, for example. And then option 3, 40% chance of running out of money. But look at that. But when I do run out of money, it's only a slight reduction. So percentage of time this happens today. I don't need you to memorize any of this. Understand though that there are trade-offs that people can make by saying, I'm going to increase how bad I'm going to increase the level of income in the bad state, which is going to cost me money, which means it's more likely that I'm going to end up in the bad state down the line. But I won't mind it as much, and because the outcome in the bad state is not nearly as bad, I am therefore willing to take on a little bit more risk now because I won't mind it as much. So I won't ask you anything about these scenarios. Okay, getting into the very last piece of it, and again, I apologize, I know this is new information on business entities, but I am still going to be brief when I cover this. The different types of business formation. So proprietorship is basically a formation. It is really not a business formation. It's just people open up the doors and start doing business. Then we've got general partnerships, and then we have limited partnerships. I don't like the fact that those are on the same bullet point because those are two totally different things. We have limited liability companies, C corporations, and S corporations. Okay, this is how I want you to think about each one of these. So I want you to understand the ease and cost of formation, the complexity of management and governance. This just means ongoing. Just think of this as formation is number one, operation is number two, and then transferability. How do you get out of it? Or dissolution. How do you get out of it is number three. Liability protection. That's one of the main things that we want to consider. That's when we have a business formation, and then what are the tax consequences. So actually the bottom two are the two things that we consider, the costs and the in terms of the benefits of these, and then the top three are just other factors that we should consider when we're doing each one of these. So let me go back. A sole proprietorship, the two main things, liability protection, it doesn't have it. Taxation, you're just taxed as an individual. A general partnership is basically like a sole proprietorship with more than one person who owns the business, but there's really no business formation there. Again, no liability protection, and things are taxed individually, and they can get messy, but it's according to who takes what. Pass through. And then we have, I'm going to say, limited partnerships and limited liability partnerships, and then we have limited liability corporations, and I want to do S corporations next. Limited partnerships, for the limited partners, not the general partners, do offer liability protection. LLC offers liability protection. LLP offers liability protection. S corporation offers liability protection. And C corporation offers liability protection. But the C corporation is subject to double taxation. All of the others have pass-through, basically have the income pass through to the owners of the business, and the owners, because generally you have these when they're owner-operators, are passed through to the owners of the business, and according to his or her share of the business, and then they pay taxes at the individual level, very much like in the sole proprietor and the general partnership. Okay, so that overview, if you listen to what I just said as it relates to these slides, will get you a long way as it comes into this. Now, just pay attention to the slides that have advantages and disadvantages, and look at the advantages and disadvantages of each. Key thing is sole proprietorships and general partnerships is unlimited liability. And in partnerships, each partner is liable for partnership debts and obligations 100%. So one person can, escape town and stick, or leave the country and stick the other person with it. So that can be a potentially very damaging thing. Limited partnerships, these are generally things where the general partner, these are generally investment conduits. These used to be a lot more common in real estate limited partnerships before a Tax Act in 1986. So limited partners, you got limited partners have limited liability. General partners take on the liability of the business, but the general partner has the general power. The limited partners have very limited power in terms of running the business. Again, pay attention to the advantages and disadvantages. LLP, limited liability partnerships. These are typically done by professional organizations, so you might see law firms, engineering firms that are LLPs, professional organizations. One of the key things is you have when you have professionals that are doing things, let's say like doctors, medical practice with multiple doctors might be an LLP, limited liability partnership. They have unlimited liability for their own acts of malpractice, but each doctor is protected from the acts of the other doctor. So it is not enough to just have an LLP. You must have malpractice insurance. Each doctor must have his own malpractice insurance. Family limited partnership I'm not even going to cover because that is more of an estate planning strategy more than a business partnership type of strategy. LLCs are a very common type of business formation for small businesses. Members have limited liability. I won't make you understand. Won't make you say, where someone's taxed, whether it's on a Schedule K1 or on a Schedule C or anything like that, or a Schedule S. Just understand that they have limited liability. Understand LLCs have limited liability and typically have income is passed through to members, usually on the Schedule C1. And here's some of the disadvantages. Okay. One of the key disadvantages is the limited life, often by termination on death or bankruptcy of a member, but the business can then be reformed. It just becomes a little bit of an administrative hassle. And then C corporations, those are the ones where you have potential double taxation. Corporate pays the amount that's passed through to, let's say, owner-operators. Not talking about, we'll focus on stock companies. I hope you'll focus on that in investments and tax classes. Let's just say small businesses that elect to be C corporations. I'm the owner of my own C corporation. I pay myself a salary. That is a deductible expense for the business. And then I pay individual income taxes on my salary. Anything else that is retained in terms of profit by the business is taxed at a corporate income tax level. And our corporate income tax schedule is compressed, so likely to be at a higher income tax rate than I am individually, but there may be reasons that I want to retain that. If I then want to later take a distribution, then that would be considered a dividend, and it would be subject again to dividend taxation. So, and C corporations have a little bit more hassle in terms of the administrative requirements. S corporations have a limitation on the number of shareholders. C corporations can have multiple classes of stock, which can some voting and some non-voting stock. S corporations cannot, but S corporations do allow the pass-through. So normally for small businesses, the thing is to elect whether or not you're an S corporation or an LLC. So pay attention to those two things. Okay, that covers it for exam 2.